everyone, and welcome to this economic impact video. Today is September 15, 2022. As usual, I am with Stéfane Marion, our chief economist. Hello, Stéfane.
Hi, Martin.
Today we're going to break protocol, and I'm going to let you, Stéfane, tell the story. There's a lot of content. There's a lot of volatility. It's difficult to make a forecast at this point. I'll let you go for 7 or 8 minutes and we'll recap at the end.
Yeah, thanks for allowing me a monologue, Martin. So I just want to start that, yes, it's not easy to make a forecast. I will present our baseline forecast, however, and the challenges that central banks are facing. I know many financial institutions are now calling for a policy mistake, recession call. We still assume that the central banks do want to avoid such a policy mistake. But let's speak to the scenario. One thing is clear: central banks are determined to bring inflation down, and the reason for that is that inflation is above 2% pretty much everywhere across the planet. It ranges from 3% in China to 12% in the Netherlands, and that is well above the 2% target normally set by central banks. So what central banks are doing when inflation is above 2% everywhere, well, they're all reacting by raising interest rates at the same time. Well, Martin, what are the challenges we have? If everybody drains the economic pool at the same time, the water level will come down much faster than if you do it on your own. So the central banks keep arguing that raising interest rates now will only impact inflation 12 to 18 months down the road. Well, maybe that's a traditional model when there's only one person doing it, or just a few. But if everyone does it, the lead lags might be quite different. So that's why they have to be careful. Slippery slope for central banks right now. Now, the rise in interest rates is actually having a big impact on growth. Growth is decelerating, and you can see that manufacturing activity, Martin, it's above 50. It's still growing, but it's a lot less vibrant than it was a few months ago. So clearly there's an impact of higher interest rates on global growth. And the other thing from a central bank perspective, let's not forget that inflation is a lagging indicator. Inflation today reflects the growth that we had last year. And now with interest rates rising, we're going to get very slow growth in the coming months. And that will translate into inflation that could come down much sooner than a year from now, because everyone's doing it at the same time, as I said before. And Martin, we spoke to this before, and you've been a proponent for that. The supply constraints are still a big explanatory factor of why inflation is so high at this point in time. Case in point, if you take this study made by the U.S. Federal Reserve of San Francisco, they look at the green portion of that, the green section of that chart, of that bar chart. You can see that roughly half of U.S. inflation right now is due to supply-driven inflation. So that's the global supply chain that has yet to normalize. China is still with the zero COVID policy in place, impacting its manufacturing output quite significantly. So yes, there are still structural factors that are at play, and that might be receding quite significantly in the coming weeks, coming months. So the issue for central banks, Martin, right now is if you do too much tightening, you get too much financial stress. Too much financial stress is normally confirmed with a US dollar that is really strong, too strong normally. And if you breach a certain level, then it turns into a recession. And a recession is a policy mistake. Again, Martin, our scenario is that central banks will want to avoid a policy mistake. At some point, they need to pause their tightening cycle. Right now, when you look at the performance of the US dollar, well, it's the highest in a generation. So clearly the US dollar is at a very elevated level that is adding financial stress. So we don't want to go too much higher than this level at this point in time. At the same time, we can't forget that higher interest rates means higher mortgage rates, which means a negative wealth effect for many households, because home resale activity is coming down quite significantly. From a Canadian perspective, we're now back below the 10-year average in terms of home resales. Now, fear not, from a Canadian perspective, demographic factors are still quite supportive. There might be a little bit more downside from current levels, but we don't think it's the same downside as 2008, 2009, or the worst of the pandemic, just because the population growth that we're experiencing right now in Canada is the best since 1993. So that means more household formation. So there's a downside, there's a limit to the downside on home resale activity for Canada. But of course, interest rates need to pause at some point in time, and we hope they pause in October. The reason why we think there's resilience for the Canadian economy versus others is because real disposable income, that's after adjusting for inflation, is still on the pre-COVID trend, which is the red line on this slide. Not the case in the US, and certainly not the case in Europe. Both countries are also raising interest rates. So obviously, you're going to get a slowdown that will be more significant in US and in Eurozone, and that will depress global economic growth and obviously bring down inflation, which is our scenario at this point in time. So the other thing is central banks are looking at is to say, we're going to hike until we see a slowdown in the labor markets. Well, it is true that total employment growth is strong in the US. However, it's mostly part-time jobs. If you look at full-time employment, both in Canada and the US, you can attest on this slide that it has stabilized. It's actually stalling for the past 3 to 4 months. So corporations are saying, well, I'm not going to hoard labor right now. Full-time jobs, full-time employees cost a little bit more, and I'm not sure about the outlook. So that slowdown in the pace of hiring is what the central banks are looking for to take a pause on their tightening cycle. So at this point in time, I think it's really important to look at the dynamics of full-time employment. And again, I stress the point that central banks are not really interested in saying massive layoffs. So that's why it's important to take a pause with the tightening cycle. Our view, Martin, for the next few months is we assume that the pace of inflation deceleration will be much faster than what we saw in July. I think it starts in August. If we are right, that puts a ceiling on the overnight rate in both Canada and the US. That ceiling in our current forecast is at under just 4%. But the markets are not sure. That's what brings the volatility, Martin, because if they're saying if inflation doesn't come down, then they're going to push above 4%, and it's an even slippery slope for the global economy. So inflation in the current forecast goes down to 3% about to start next year, and that will put inflation in a much more comfortable zone for the central banks. But again, I think that we should start seeing this already in October. If commodity prices stay where they are right now. In essence, what it means for the Canadian economy, growth next year, still growth, that's good news, but slow growth, 1%. Slow growth of 1% is well below potential growth, which means that inflation will decelerate. But in the meantime, Martin, we have to be careful. We have yet to confirm that inflation is coming down faster. And that's why we've seen the second quarter was not good for financial assets. The third quarter is turning out to be okay so far so good. We're near the end of the third quarter. It's positive return. The blue bars on this slide are all positive. Year to date, still challenging. The issue that we have, Martin, going into the fourth quarter, we're still uncertain about the banks' this decision process as to whether or not they will take a pause after October. I need to confirm my inflation data for the next few months, which makes it a bit challenging, and therefore maybe for our investor base to be a little bit more prudent under these circumstances.
So, Stéfane, very interesting. We rarely hear about the structural part of inflation. So, what are the central banks dealing with? They're protecting their credibility versus the core part, the structural part of inflation?
I think they're in catch-up mode. They've been frustrated that they weren't able to predict the upsurge in inflation, and it's as if they have abandoned the storyline where a good proportion might be to supply forces. And in a sense, it makes sense because they've been frustrated by the supply chain. China's opening its economy, closing it, opening, closing it. So to the extent that the Chinese economy stays open a little bit more after October, I think this is where we will see the structural component, the supply side component that will bring inflation down.
And 1% growth is very close to a contraction of the economy, and that's why it's a very volatile situation.
Well, you could say it's stall speed. Yeah, 1% is not much. We're coming down from 4%, but it's still positive growth. The point, Martin, is that you don't have to go into economic contraction or recession to get inflation down. At 1%, it will come down.
And so more than ever, I think it's important to tell our investors to talk to their advisor. We recommend to be prudent at this point. And, there's a lot of different outcomes in our scenario. We didn't talk about geopolitics, but there's a lot going on.
Yeah, moving the overnight rate above 4% in both Canada and the US will become very challenging for the global economy and for the domestic economy, obviously, Martin. So that's why prudence is probably the name of the game for the next few weeks, next few months. We have to confirm that downtrend on inflation, which has begun, Martin. It's just not happening fast enough to calm the central banks. They need to pause after October. If not, it gets a bit more challenging.
Thank you very much, Stéfane. Thanks for listening to us. Please send us your comments, and we will see you in 1 month. Take care.